taxation rate and charges on your mutual funds and stock investments. Investing in Indian and foreign stocks or mutual funds can give you massive returns in a short time. While many investors pour money into these investments for higher returns over time, few people realize the tax implications on stock and mutual fund profits. If you don't pay heed to stock and mutual fund taxation, you may be in for a nasty shock as you will lose money to taxes. While taxes do eat up returns, mutual funds and stock charges chip away slowly and you barely notice them. However, don't take these charges lightly as even ships sink because of a small leak. Hello and welcome, I am Prarthana from Clear, India's largest tax and financial services platform. Thank you for subscribing to us. If you are not subscribed, join us to grow your wealth. Mutual funds pool money from several investors and invest in equities, bonds, money market instruments, and other securities based on the fund's objectives. The mutual fund is managed by the fund manager. Stocks represent part ownership of a company. Stocks are of two types, common stock and preferred stock. Common stock gives you the voting rights while preferred stock does not give you any voting rights. Preferred shareholders are legally entitled to receive dividend payments before other shareholders. International mutual funds invest in stocks of companies located anywhere in the world other than domestic stocks, in this case Indian stocks. For example, international funds may invest in stocks of Facebook, Netflix, Amazon, and so on. Smallcase is curated theme-based portfolio. It is a basket of stocks designed by SEBI registered investment advisors which identifies a central idea and picks stocks that benefit from this idea. For example, a small case which focuses on rural consumption may invest in stocks of HUL, Hero MotoCorp, Mahindra & Mahindra, ITC, and so on. Here is the difference between equity funds and small case. Profits earned from the sale of mutual funds are called capital gains. The taxation of capital gains depends on the type of mutual fund. Mutual funds with 65% allocation towards equity and equity-related securities are called equity-oriented funds. Otherwise, it is a debt-oriented mutual fund. There are separate taxation rules for equity and debt-oriented mutual funds. The dividend from mutual funds are added to your taxable income and taxed according to your income tax slab. If you sell equity mutual fund unit in 1 year or less, your capital gains are called short-term capital gains. However, if you sell units after 1 year, the capital gains are called long-term capital gains. If you sell debt mutual funds in 3 years or less, your capital gains are called short-term capital gains. However, if you sell units after 3 years, the capital gains are called long-term capital gains. Indexation adjusts the purchase price of the mutual fund for inflation, thereby minimizing capital gains tax. Balanced funds invest in a mix of debt and equity. Balanced funds with 65% or higher allocation towards equity are taxed as equity-oriented funds. Other balanced funds are taxed as debt-oriented funds. The capital gains you earn from stocks are taxed similar to equity-oriented funds. Moreover, as small case stocks are stock investments, the capital gains are taxed just as equity-oriented funds. Small case offers you a curated portfolio of stocks set according to a strategy or theme. Small case are available at many of India's largest stock brokers and managed by a fund manager. Some brokers offer you an opportunity to create your own small case by selecting stocks and constructing a portfolio. You can pick a small case based on your favorite theme. For instance, you can pick a small case which focuses on rural consumption. It invests in stocks of companies that derive bulk of their revenues from people who reside in rural areas. The minimum small case investment depends on the price and weightage of stocks in their portfolio. Indian investors can invest directly in US stocks. Investing in US stocks can fetch you capital gains and dividends just like Indian stocks. The taxation rules of short-term and long-term capital gains from US stocks differ from Indian stocks. If you sell US stocks in 2 years or less, your capital gains are called short-term capital gains. If you sell US stocks after 2 years, the capital gains are called long-term capital gains. Speaking of taxation of dividends from US stocks, the dividend from US stocks is taxed in the USA at 25%. This tax is withheld by US companies and you get only the balance 75% paid out as dividends. The dividend you receive from US stocks is taxed as per your income tax slab in India. As the US and India have Double Tax Avoidance Agreement, that is DTAA, the tax withheld in the US can be set off against the tax liability in India. Investing in international funds diversifies your portfolio beyond the Indian stock market. For instance, USA and Indian stock markets have a low correlation between 0.1 and 0.2 over the last 20 years. Low correlation offers excellent diversification opportunities. International funds have foreign stocks as underlying assets. Financial experts recommend having 5% to 10% of your portfolio in international funds. International funds are taxed in a similar manner as debt funds. If you sell international funds in 3 years or less, your capital gains are called short-term capital gains. If you sell international funds after 3 years, the capital gains are called long-term capital gains. I hope by now you have understood how mutual funds and stocks are taxed. Don't you want to know the charges on mutual fund and stock investments? Investing in mutual funds involves several charges and you must be familiar with them before commencing your investment. Mutual fund charge an amount from investors when entering and exiting a mutual fund scheme called entry and exit load. SEBI abolished entry load from all mutual fund schemes from August 2009. Mutual funds may charge an exit load if you redeem the investment before a specified period of time, and it varies from scheme to scheme. Exit load is charged as a percentage on net asset value or NAV and ranges from 0.5% to 2%. Mutual fund houses incur annual expenses towards administration, fund management, and other expenses to run their schemes. Expense ratio, also called the total expense ratio or TER, is the percentage of average assets under management that go towards such expenses. Take a look at the TER for open-ended mutual fund schemes. This tax is levied when purchasing or selling securities listed on stock exchanges in India. You incur STT when buying or selling units from equity funds, equity-oriented funds, and derivatives. Talking of stamp duty charges, you incur stamp duty charges on the issuance and transfer of mutual fund units irrespective of the type of mutual fund. It is a direct tax levied by the government under Section 3 of the Indian Stamp Act 1899. As per SEBI rules, a stamp duty of 0.005% is levied on the purchase of mutual funds including lump sum, SIP, STP, and dividend reinvestment. You don't incur stamp duty on the redemption of mutual fund units. A stamp duty of 0.015% is imposed on the transfer of mutual fund units between demat accounts. You incur many charges and taxes when buying and selling shares in India. Let's look at a few prominent charges when trading in stocks in India. You incur Securities Transaction Tax or STT when buying and selling shares. STT is charged on buy and sell side share transactions for delivery-based trading at 0.1% of the total transaction price. You incur an STT of 0.025% on intraday trading only when selling a share. Stock exchanges charge transaction fees on the buy and sell side of share transactions. National Stock Exchange (NSE) charges a fee of 0.00325% of the total turnover as transaction charges on equity and delivery trading. Bombay Stock Exchange or BSE charge a fee of 0.003% of the total turnover as transaction charges on equity and delivery trading. SEBI charges a turnover fee of Rs 10 per crore of the total turnover on both sides of the transaction, buying and selling, and is same for equity trading and delivery. The two stock depositories of India, the Central Depository Service Limited and National Securities Depository Limited, charge a fixed sum for keeping your transactions in electronic form. The depositories don't charge the investors directly but charge the depository participant, who in turn charges the investors. On screen are the stamp duty charges on stocks. Well, the bottom line is you must pay heed to taxes and charges of your stock and mutual fund investment, as they can eat up your sizable returns. Do check the after-tax returns of mutual funds and stocks to gauge their tax efficiency. Subscribe to our channel to get clear explanations of finance concepts. Thank you so much for watching the video. Stay tuned for the next video.